The changing of the guard is happening. NVIDIA, who just a couple of years ago was a video graphics card maker, is now the third biggest stock in the world. And now we have to seriously start asking the question, are things getting too frothy? Today, we answer that and also what opportunities could still be on the horizon as big tech weakness comes clearly to the surface. But we also need to talk about OPEX and what normally occurs before, during, and after quadruple witching. At the same time, we have a big CPI print tomorrow. A miss could really send the markets downward, so we have a lot to discuss. Let's do it together. Hello ladies and gentlemen, welcome to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell. Let's get into it. And the weekend poll is officially in. Thank you so much to everyone who voted. I really appreciate it. 53% of you believe that the next 100 points in the S&P 500 will be up. 47% of you say down. And we're going to talk about what I think, because there's been some major changes under the hood, especially in the gamma condition and what the options market is pricing in. So we're going to talk about that in today's video. So go ahead, subscribe so you don't miss these. We do these every single day, guys. But that being said, I would say it's a pretty 50-50 vote here. This tends to be a contrarian indicator. I believe last week we actually had more votes on the downside and the market actually rallied quite significantly. So take this with a grain of salt. That being said, 485 votes isn't really enough to have anything statistically significant. And we'd also probably need like a year of data. We've only been doing these for about 2 to 3 months. But that being said, I do appreciate every single vote. It is really good to see what you guys are doing, and it's great engagement in the community. So thank you so much, guys. But looking at the market as a whole, yeah, the big names, the Mag 7, as well as technology. I mean, look at semiconductors, very mixed and mixed. There was weakness in there. There was some strength, Qualcomm, Intel, and then software as well. What did perform well was like NXPI, Qualcomm, ITC in semiconductors. These are more industrial semiconductors, companies more than anything else, and that's why they performed well. But yeah, weakness across technology, and we could definitely see a broadening out. I mean, let's have a look at comm services, right? We could see, look at entertainment, look at telecom services right here versus Google and Meta. So it was definitely like sell the larger caps, probably those names that are more concentrated in your portfolio, and go for like smaller names like this. And we can see the same is true here in the cyclical sector. But look at utilities, absolutely soaring. Same with healthcare, energy, industrials too. It was half and half in financials. I mean, if you probably remove Berkshire, a pretty green day across financials as a whole. That being said, a clear broadening out happening in the market. And we can see this in the indices. Look at the IWM, look at the mid caps, look at the RSPs. You know, higher beta was the way to go today. And the IWM is up about 5% in the last 3 days. It's breaking out and above some key resistance zones. And we're going to talk about that in the charts a little later on in the video. So watch until the end, because we're going to do a full chart analysis of all of these indices. And we actually have a look at the RSP, up 0.7% for the day, outperforming the SPX, which was relatively flat, and the NASDAQ 100, which was negative on the day, led by the large caps. Now guys, this is the S&P 500 daily chart. So something I want you guys to note, the 80-hour line finished at an all-time high, as the S&P 500 doesn't close at all-time highs, but it did go ahead and wick into all-time high territory. And if we actually have a look at the chart as a whole, more specifically in depth, what we did see was a mild gap down and then a sharp rally higher, and then bears came in at the wick towards the end of day, middle of the day, and then brought us all the way down, and we actually closed in the bottom third of the candle. Now that is kind of bearish on a daily basis when you look at it, but the fact that we actually wicked up into all-time highs, very, very bullish. Now looking at the 5-minute chart, this is where we opened at this point right here. We then had some consolidation, a rally up. We then formed a double top and a sharp move lower. And then buyers did find a bit of value right here at this 520 level. You could see quite a bit of buying there, and there. That being said, sellers were still victorious on the day. And something I do want you guys to notice is this right here, VIX, up 7.89% for the day. And right here, when the S&P 500 was up like 0.3 or 0.4%, VIX was actually up 6%. So when you see stuff like spot up, VIX up, that's really an early warning sign that something is happening under the hood in the options market that you don't really want to see, and that maybe a pullback or a correction could be on the table, on the cards very, very soon. But that being said, there is a bit of warning signs here with the VIX. So do keep that in mind, guys. Now guys, over the next couple of days, we're going to go through JP Morgan's guide to the market. This is a report they release every single quarter. They released this about a week ago. It's for Q1 2024. Now a lot of the data is from December 31st, but still very relevant data, especially when you look at what they are expecting over the next 5 to 10 years. So let's get into it. So we're going to break this down over the next 3 days. We're going to be talking about US equities versus international equities, and then fixed income as a whole, as well as tackling some tidbits about the economy and about JP Morgan Asset Management. Think of it all. Great stuff in here. Now, S&P 500 PE ratio and equity returns. So this is the forward 1-year returns and forward 5-year returns. And in both instances, based on where PEs are right now, close to this 20 level, as you can see, the forward 1-year returns is about 6%, as you can see right here. And then the forward 5-year returns is about the same, about 5 to 6%. So based on these PE ratios we have here, the forward returns are not that great. And that's why when we do get a pullback, 10%, 5%, 15%, when we do get these pullbacks, we do need to capitalize because it's going to substantially push this little red box further up the scale. And that's actually what you want, especially if we get these 15% correction. Then you're looking at pretty substantial returns over the next 1 year, over the next 5 years. Now, value versus growth, relative valuations. Now we can see here that growth relative to value is extremely expensive, and actually value is historically cheap relative to growth. And the last time growth was this expensive relative to value was sort of at like the 2020, 2021 highs. And then right here, the tech bubble. So both times we saw historic moves in the S&P 500, in the NASDAQ 100. And here we are again, but not quite as expensive relative to value as it was a couple of years ago. Now, value versus growth in different interest rate environments. And we can see here that value tends to outperform in higher interest rate environments ever so slightly. But in lower interest rate environments, growth tends to outperform. And we do know why, because firms will take on more debt, which is a lot cheaper, and they'll press for more growth. The sweet spot tends to be the 3 to 4% range, which is where we are right now. But this is if companies do need capital, right? A lot of these big tech firms and just a lot of companies in the S&P 500 are so well capitalized now that sometimes the cost of capital doesn't even really matter. And they really just use debt as a way to buy back their stock and provide shareholder value. Like Apple uses a lot of debt to buy back their stock as well as the capital they have on hand. But like R&D expense and that type of expense, stuff like Meta, stuff like Google, they just take it out of their own pocket every single year because they just make so much cash. And we can see this is true with cash, R&D, and CapEx. Now, this is corporate cash as a percentage of current assets by sector. Look at tech, look at comm services. 49% of their cash balance, they have 49% of their assets in just pure cash balance. And we can see the same is true for comm services. So this is like Google, Meta, Netflix, Disney, these companies right here, Apple, Microsoft, NVIDIA, they have a ton of cash available. And the truth is, even you look at consumer discretionary, healthcare, real estate, still well above the entire industry as a whole. And the S&P 500, the average stock has 31% of their cash values relative to assets. And you could say that 31% of their assets are probably in cash. And this is why growth has outperformed value over the last 10 years, because we look at growth capital expenditure, growth R&D spend, it's significantly higher, right, in terms of the average in the last 10 years versus like these value stocks right here based on their capital expenditure, right, and based on their growth rates. You could definitely see this is why growth has outperformed, because they're putting more money into the business to grow as well as innovate. And this is why I do think that growth will continue to outperform value. That being said, if you can get growth at a reasonable price, that is the best of both worlds. Now, index concentration, the performance of the top 10 stocks in the S&P 500, I believe this is in 2023, 86% of the returns in the S&P 500 came from the top 10 stocks. 14% came from the 493. And that's why the top 10 have a forward PE of 26.9, while the remaining have a 17.1 forward PE. And then the average in the S&P 500 is about 19. The weight of the top 10 stocks equals 32.1%, and their earnings contribution is very close to 24%. So even though they are heavily concentrated, they do have the earnings to back that up. Now let's talk about small caps versus large caps. Now, this is the percentage of unprofitable companies in the Russell 2000, and it's sitting at 41%. What has really led to this is just a ton of cheap credit, rates being at near zero. And this is where we're sitting right now. Although not the highest ever in 2019, 2020, we were sitting at well above 50%. So either a ton of companies went delinquent or a lot of companies became profitable in that time. That being said, still sitting at historically high levels, even compared to what we saw in the dot-com bubble. And this is where it kind of gets a bit scary. You can see that the debt outstanding, right, in 2024 to 2030, so in the next 6 years, 47% of small cap companies have debt maturing. 38% of that debt is floating rate. So they are highly sensitive to interest rates. And that's why we see when interest rates fall, the Russell reacts positively and vice versa. This will change after 2030, because 49% of debt will be maturing by large caps, but that's because large caps have more leverage to take out debt further on into the future. Banks don't really want to take that risk with small caps. But if we actually look at the sector composition, we could see here that large caps in terms of technology really outperform. Small caps have a higher weight in industrials, and it's relatively the same almost in every other sector. These industrials and tech are the only real two outliers. That being said, this right here is incredibly scary, because who is going to refinance an unprofitable company? Now, looking at S&P 500 sources of earnings growth and profit margins. Now, S&P 500 profit margins is currently sitting at 11.7%. Not too bad, not too good. I would call it pretty average. It'd be pretty low for a tech stock, but pretty good for like a retail stock. This is the S&P 500 year-over-year pro forma EPS growth. Now in 2023, there was actually virtually no earnings coming into the market. We could see that in 2023, we had a 3.2% revenue growth, 2.4% margin compression, share count decreased by 0.3%, and total EPS increased by 0.4%. Ever so slightly decrease compared to the historical averages you could see here. But that is set to change in 2024. 2025, we are expecting about 11% earnings growth in the index for 24, and then 12% in 2025. Right now for 2024, we actually are tracking that pretty good, at least according to earnings expectations and analyst revisions. Now looking at economic growth and the composition of GDP. GDP right now consists of 67.7% consumption, so the consumer right there holding this whole economy together, 17.4% government spending, 13.9% investment ex housing, and then 3.9% housing investment, also negative 2.8% for net exports. We could actually see here that GDP is generally following this trend, and we do know that the GDP now figures is sitting at 3.4% right there. So we should see further movement into this trend line over the next couple of quarters. That being said, 2% GDP growth is generally what you want to have. If you have GDP growth that's too high, you can really get like a hot economy and high inflation, and if it's too low, you can get deflation. And 2% seems to be the sweet spot. Let's actually talk about inflation and CPI. So we get inflation data tomorrow. Headline inflation is currently sitting at 3.2%. It was revised down to 0.2%. We are actually expecting inflation to come in at 0.2% later this week on Tuesday, I believe. Now, what we can actually see here is that based on this figure right here, if inflation is to come in at 0.2% every single month, foreseeably, we will actually get to the Fed's 2% inflation target. Never. If inflation comes in at 0.5%, we will actually get to the Fed's 2% target year in August. If we report inflation at 0.1% month over month, we'll get to the Fed's 2% target here in July. And you guys can go ahead and look at these figures if we report 0% inflation or 0.05%. That being said, what we really want to see is a mix between 0.2, 0.5, and 0.1% inflation month over month increases. If we get that, we should sustainably get to the Fed's 2% inflation goal anywhere in the middle of the year, in June, July, August, somewhere around there in 2024. Now guys, let's quickly talk about earnings. We had earnings today. We had Waste Management, Cadence Design Systems. I didn't look over them extensively. Pretty good earnings, I think, for the most part. Don't quote me. But tomorrow we got a pretty big day of earnings, and we're going to be covering all of these earnings ad nauseum. Guys, so we're currently in some trades. This is the last day I'm going to be going over this specific trade, and then I'll give you the updated results at the end of the week. Now, this is the pre-President's Day week when the calendar year is positive. So we have a calendar year positive, and normally on Monday, Tuesday, and Wednesday of this week, we can actually expect quite a positive return with quite a great hit rate. The average return since 2000 is 1.1%. Now, we do want to be out of these trades on Thursday, simply because Thursday and Friday after Vixpiration, which is on Wednesday, and the OPEX day tends to be pretty negative. Average returns on the day of OPEX tend to be negative 0.24%, and the hit rate is not quite there. So you do want to be out of the trade by Thursday, latest Thursday afternoon, Friday morning. You really want to get out of that trade. Options expiration week tends to be fairly neutral. It tends to be quite a positive week. However, in the last 4 years, it has been very negative. And that being said, the week after also tends to be quite negative with an average return of 0.72%. And the reason that happens is because of the window of weakness. The market goes through cycles, and in a month, Vana and Charm start in week 1. The Vana and Charm flows are the strongest in week 2 and OPEX week, and then once all of this options expire, these dealer supporter flows, Vana and Charm, leave. They're not quite there. It doesn't mean the market's going to crash. It's just that those supportive flows, those dealer hedging effects are not in the market. And generally from about expiration, even OPEX, right? Generally till about the end of the month. So it's about a week and a half when these flows are not in the market, and then they start making their way in the first week of the next month. Just something to note there, that a lot of what we're seeing in the data and then Jem Carson's framework sort of do align together based on what we're seeing. And I do think that this framework is very, very good. However, there is a couple of things we do need to note. After OPEX, if the gamma rolls off, right, and fixed strike vol is well supplied, we may actually see more dealer hedging flows than we're used to, especially as we go into the next OPEX month, which is the March quarterly OPEX quadruple witching. That being said, this right here will be the only time bears will be able to strike until the 4th of March. After that date, if bears haven't done what they're supposed to do, which is take the index lower, as in a physical pullback in price, then we probably just continue higher into the March OPEX. Now, according to seasonality, based on my February composite cycle, we should see some form of a downturn. This is OPEX generally right here. But like I said, if fixed strike vol is well supplied, we're not going to get this. We're just going to get this. And I'm going to keep you guys updated and let you know where fixed strike vol is sitting for the moment. Anything can happen in this time period. So subscribe to me below so you can stay updated on all the latest developments in the market. Now, actually looking at gamma specifically for this week, there's been some major changes in the tape. 5,000 continues to be the core resistance, but we are seeing 48.95 being the gamma flip, so it's moved up 20 points. To be expected with the amount of checks in the tape right now, especially positive gamma. I mean, 5,000 is the level, but look, 50, 5100 is building out. We're also seeing the 5200 strike getting built out quite heavily, and the 5300 strike right there. So a lot of bullish momentum, and we did think that it was going to stop here at 5,000. No, it's not. We really are seeing the early signs of possible positive gamma being rolled up the tape to 5100, even 5200 right here. This is extremely bullish. That being said, 5,000 is still the core resistance, and this is going to be a very, very strong support zone if we do come down and test it. And I do think we are. I do think we're going to go test this 5,000 level, have a bit of price discovery there. I do think it's going to act as a strong resistance. And then we're going to go make our way to the 50-50 level, 5100 throughout the week. But with everything that's on the tape, the amount of theta decay, gamma, Vana, Charm, dealer supporter flows, expect price to just simply move higher. Expect dips to be bought, expect rips to be sold. But all in all, expect just higher price action as we move higher into this tape, as we move up the nodes. So let's hop on the charts. Now, firstly, something I want to show you, the NASDAQ composite, guys. We're very, very close to hitting all-time highs in the NASDAQ composite. And this is really important because there is a bunch of shitty companies deep buried into the NASDAQ 100 here, especially like regional banks, insurers, utility companies. A lot of these very small names get embedded into the NASDAQ simply because it's just cheaper to list on the NASDAQ than it is to list on the New York Stock Exchange, and their quality is less stringent. That being said, we're very close to all-time highs. So, it's not just a mega cap led rally here. We're starting to see breadth under the hood, and you can definitely see this is true. Look at the advanced decline line at an all-time high, even exceeding what the NASDAQ composite is doing if you actually look at it right here. So we should see further price action if this broadening out does continue in the market. And with regards to broadening out and the RSP, and again, this was just one day of trade, a great day of trade, by the way. And we have seen this broadening out in smalls and mid caps in the last 3 days. But what we really want to see is this really go forward and capture key zones, especially in the RSP. We want to see this market go catch the 164. That's the all-time high for the RSP. And we were talking about this consolidation zone for a while, that if we were to get below the 155 level, it's not going to look good for the RSP. Now, what did we see today? We saw a gap and go above the 158, a small gap, and then a rally all the way to as high as 160. A couple of bears did come in at the top here, a bit of selling pressure, but to be expected, and still a very strong day. And hopefully we get further follow through, especially into Tuesday, Wednesday before OPEX, and we go hit some key levels, especially this level right here at 161. That's a very key level. And by the way, the RSP is at new 52-week highs. That's very, very bullish. Now, looking at the Russell 2000, and we spoke about this on the weekend video, we said this is the line we want to cross move above strongly. We did exactly that. Now the Russell needs to keep working tomorrow and on Wednesday, and it needs to go and break this 205 level. And I'm not talking about a wick, I'm talking about a close above. So it's got 2 days to do that before we do see some of these negative flows in the index on Thursday, on Friday, especially leading up to OPEX and the window of weakness. It doesn't just affect the SPY, guys, it affects the entire market. So it's not just a SPY phenomenon or an S&P 500 phenomenon, it's across the board. Looking at the mid-cap index, I believe at 287, that's a very key resistance, and mid-caps also at 52-week highs. We're seeing strength across the board. Look at this advanced decline line as well in the mid-cap sector. All-time highs in the advanced decline line, and we're also making highs in the mid-caps. Very strong breadth here. This is really what you want to see despite what's happening under the hood. And let's actually talk about what's happening under the hood. Now we could see, look at sectors, look at the best performing sectors. Now rates did come down ever so slightly today, and we saw a bit up in home builders, regional banks, gold miners, utilities. We saw energy up there as well, mining stocks, metals and mining stocks, and they were really the winners. Cyclical sensitive stocks were really the winners. If it had high sensitivity to rates, it did well, but if it also was not the big names in the S&P 500, it did really, really well. And we could actually see, across the board, look at miners, look at staples, look at financials, comp services up there too, industrials, healthcare. The industrials chart is looking very, very healthy, by the way. And all of these sectors outperform the SPY, and that's really what you want to look at. When you're looking at these sectors, it's what money's flowing into the markets, what money's flowing out of the markets, and you want to use the SPY as your baseline. You can see there is still a bit of weakness here in real estate, and maybe that goes back to regional banks. I've been speaking about that for a while now, and then software and technology, semiconductors, just being an absolute dumpster fire today. But let's be real, they've been the strongest sectors this year. Semiconductors up 17% for the year so far, and you can't beat that. You literally cannot beat that. So giving back 0.39% of gains, you take the gains you've already got so far. Now looking at NVIDIA, and I do want to talk about this as well, because this is absolutely crazy, absolutely stunning rally we're seeing. We saw this huge consolidation for quite a number of months, and now we've seen this absolute rally. I believe NVIDIA is trading right now, guys, at a 64 times PE, something like that. Kind of wild. And look, you don't really want to short this. You don't really want to get in front of this. If you are looking for a short, what you can maybe look for is for maybe the RSI to come down in the 70 level, and then you can look at a short. But one thing we're seeing with NVIDIA now, it's the third largest stock in the United States, and the fourth largest stock in the world. Nuts. Just absolutely nuts. Now let's actually have a look at the financials of NVIDIA, because it surpassed Google, which was formerly number 3. And now Google's number 4, and NVIDIA is the third biggest stock. So we're going to compare Google and NVIDIA, just the cash flows, and just to see what we're actually getting out of these stocks. So for the last trailing 12 months, NVIDIA reported $44.87 billion worth of income. And you could definitely see that, just a year ago, Q1 2022, $8 billion, all the way to Q3 right now, $18 billion. That's some major growth you could see in just about an 18-month period. So definitely that's why that valuation is there, because of the growth that it can be expecting. We then see a cost of goods, negative $13 billion, and they have a gross profit margin here of $31.4 billion. That's actually a very, very healthy profit margin. When you look at it, it's a high margin business. We then come all the way down to net income, and they turned $44 billion into net income of $18.89 billion. So yeah, very high margin business, very high quality business. But you can see here that only $44 billion worth of net income compared to Google, right, Alphabet, $307 billion. NVIDIA is looking extremely frothy with this valuation, but maybe Google is a bit depressed. I mean, Google is trading at about a 21 times PE, whereas NVIDIA is trading at a 64 times PE. And, this goes to say that Google is actually looking at growing its earnings at 14% for the next year. So it's not like this isn't a growth story. It definitely is. But look at this. $307 billion in revenue, net income $73 billion. Here we are, crazy times when you think about it. Now, looking at a crazy stock as well in the semiconductor industry, ARM. Guys, now the reason why this stock is up another 30% and up 100% in the last 3 days has to do with the float. Only 10% of this stock's float is available to be bought, and that's why we're seeing these huge moves in ARM. So SoftBank holds the other 90%, and they can't sell any until the 12th of March. So on the 12th of March, they can sell and release more shares. Maybe we'll then see a stabilization in the price. So until then, if you actually are looking at buying ARM, maybe just wait until the 12th of March. Maybe SoftBank are going to sell quite a bit of shares, and we get a pullback into this 100, maybe 90 level right here where this gap was. and then you can maybe assess ARM and go from there. And looking at Roku, this is one of the trades I gave to you guys at the start of the week. It's playing out exactly as I said. I said we're looking at this head and shoulders pattern right here. And then we actually got the rally we were expecting, and expect follow through, expect a run up into Roku's earnings on Thursday. McDonald's, another play I gave to you guys. We saw this head and shoulders right here, and we said that if we get a rejection on this line, we would then take shorts. We actually did come up, we got the rejection, perfect entry point right there, and we can then look for 282. Now data guys, so we got CPI data tomorrow, we got retail sales data later on in the week, mortgage applications, initial jobless claims, Empire Manufacturing up, big week of data and earnings, and then we also get PPI and Michigan sentiment. But if you've made it up until the year guys, thank you so much for watching. If you like this video, please subscribe, hit that notification bell guys, like this video, cheers.